Hello, everybody, and thank you for joining me today. It's Allan Laboucan with the Rocks and Stocks News Show. I've got a show related to the Federal Reserve meeting. I'm going to have some stock charts. I'm going to have some or metals charts and other charts. I have a couple of companies to talk, a few companies to talk about, and basically those companies are what I consider a great way to play what's happening with the Federal Reserve and some of the economic indicators. So the title for this show is going to be Fed continues to throw inflation under the bus due to concerns about jobs and economy, increasing the chances of problematic stagflation. And I believe the strongest way to play stagflation is through the gold, silver, and the precious metal stocks. So I'm going to deal with those things while I'm talking about my notes from the Federal Reserve meeting. I'll leave the gold chart up here, but I'm going to talk about other charts. You'll notice that right out the bat, after the Fed meeting, gold came down and then it bounced off of that in after hours trading. So let's get into the notes that I got from my from the Fed meeting. The key talking points that we heard throughout Fed chairman's speech and then his questioning. Those talking points were dual mandate, came up quite a bit, dissent, quantitative easing ends in December, AI is causing layoffs, quarter point move to 3.75 to 4%, and that December is not a foregone conclusion. The dissent came from one of the members, Schmidt and Murin. Stephen Murin is the appointee by Trump, and I believe he's auditioning for the chairman's seat. And I also believe that he's failing miserably as he is unable to convince the Fed board to cut by a half a point. His dissent was to cut by a half a point, where it was unanimous amongst all the other members except for Schmidt, who wanted to not lower by a quarter point. I predict that, and I didn't hear anybody else talking about it today. I believe that Mirren will not be the next Fed chairman due to his inability to convince other board members to cut by a half a percent. I believe that, that sends a message to Trump that he's not able to do what Trump wants by cutting more aggressively and unable to convince the rest of the board of the Federal Reserve to do that. And therefore is why I don't think that he will get the Fed chairman position. I call the next group of notes that I took my chuckle points. Um, I think that they're somewhat laughable to the point that I almost spit up my coffee while listening to it. But here's some of the points. Uh, Powell talked about inflation up and or referred to it as somewhat elevated. This is laughable because they talk about their target rate being 2%, and it's currently at 3%, and he calls that somewhat elevated. Well, it's a full percentage point above their target rate, so I think that's a little more than elevated. He talked about job gains moderating when in reality they're in free fall, which is why they're cutting despite inflation picking up. There, he was still Powell was still pitching their 2% target, while it is 3% and going higher. And real inflation is much higher. They talk about their their target rate being 2%, and it's now 3%, but that's using the government data, and I think that's laughable. The government data is nowhere near what the real inflation and the real economy and consumers and corporations have to deal with, which could be double what the government statistics are suggesting. But talking about pitching your 2% target when you failed so miserably is kind of a joke. He also talked about tariffs being short term or a one-time effect. How he can pitch that, it boggles my mind because the tariffs don't just uniformly hit everybody in the same way. Some companies will try to fight from passing those on to consumers. Others will have it happen right away. And so there's a staggered effect to the tariffs making their way through the supply chain. So I don't think that it's going to be a one-time effect. This staggering will cause it to be much longer than a one-time or short-term effect. He does talk about no risk-free path. Is that ever an understatement? The translation for that is there is no tools that can fight stagflation. They can only make it worse. He mentioned the 2% goal multiple times without saying anything about them failing miserably at that effort. Well, they're trying to get it down to 2%. It's now at 3%. And while it's at 3% and going up, they're cutting interest rates. So, that is unbelievable that he talks like that. The risk management, he calls it a risk management move, maybe for jobs and the economy, but certainly not about driving inflation higher. This is not a risk management situation. Well, I guess it is if you're concerned about the jobs or the jobs and the economy, but it is certainly causing a problem on the inflation side. He said he's not, Powell said he's not concerned about AI spending ending, which is one of the only things, these are my comments. These are the AI spending is one of the only things propping up the economy and the job. And so, if there is any slowdown in that spending, that could definitely be problematic for the economy. He makes the case that their policy is just right. And here are my comments. Well, if it's just right, it's doing little for the jobs in the economy. These quarter point moves are not going to do anything meaningful for the jobs in the economy, yet they are driving inflation higher when it is well above the target rate. Powell was asked about the AI boom, suggests that the rates are not restrictive, and then he dismisses it and the concerns, and he says that the interest rates aren't, or that the AI boom is not interest rate sensitive, which in my opinion is an effort to deflect away from what is really happening. Uh, he says that the Powell says that the lack of the data is not an issue. I would point out that he then mentions that the soft data will help them, which he usually dismisses the soft data coming from outside of the government data, which the government data is the one that is lacks clarity because it constantly is being revised down or up depending on which way they want it to be. And he argues it is good enough. Okay, so usually he dismisses the soft data, but now it's good enough. And I believe their hard data is a joke. I think that government numbers consistently overstate jobs and the economy while understating real inflation. You just have to go to the constant revisions to the government data to get a feeling for how unrealistic that data is. One of the questions talked about government data being the gold standard. Well, I think that's laughable because, as I just said, it's always wrong and always being revised in the opposite direction. When they say that the jobs are up, they're actually overstating. When they say inflation is down, it's understating the real inflation. And so to call that the gold standard is an absolute joke. He said Powell says that he's watching layoffs due to AI, but is not worried. Um, I think he should be, as it is bad for the jobs market and the economy. These AI-related job layoffs, and there's many of them, we see them almost on a daily basis. Not only is it bad for the jobs market, but it's bad for the economy as well, because those people are losing jobs, which they would be spending money if they were keeping those jobs. According to Powell, the exuberance in Wall Street stocks is not a problem. And I put in parentheses in my own notes, okey doke. That's my homage to the Ignatowski from the TV show Taxi. I really believe that when he says it's not a problem, it's a deflection from their own responsibility and not because of too much leverage. Interest rates are not, he says that interest rates are not causing the exuberance. He says that it's not like the dot-com era as AI companies have earnings. Earnings from what? Earnings from circular accounting. These companies are, playing accounting games. They're not, nobody's really making any money off of AI. Everybody wants AI for free or as close to free as possible. So, how is anybody ever going to make any money off of this? Sure, they may have earnings, but it's because of circular accounting. The one company uh, invests in another company, and that company then buys product from the company that invested in them. This circular accounting is a very problematic thing. And he said nothing about that. When Powell was asked about concerns for job weakness accelerating, he said, no worries, not worried, dismissed it. So if he's not worried, why are they cutting? Doesn't make any sense whatsoever. Um, he said that AI related layoffs are not a problem. And he said that with a straight face, I might add. Then he was also asked about regional bank issues and said that's not a problem either. And that he's not worried about broad ramifications. When the Fed says not to worry about something, you should worry about it. And when you see these regional bank problems, they are the canary in the coal mine. We saw the same thing happen in 2008. In fact, in 2007, there was problems that arose to asset-backed commercial paper. I don't know if you all remember that, but that was the canary in the coal mine around a year before the 2008 economic crisis. So for him to just dismiss this and say that he's not worried, I think investors should be very worried. Several times throughout the press conference and his comments announcing in his announcements, he said that he mentioned dual mandate. And they mention dual mandate all the time in these press conferences and during the announcement of the policy. But what they never mention is that they're failing on both mandates. They're failing on the jobs market. That's why they're cutting interest rates. And they're failing on inflation as it's going up and at well above their target rate. Um, and they're while they're failing at both, they've had to make a decision. The decision is to that they can either throw the jobs and the economy under the bus or inflation. They have chosen inflation and increased the chances of problematic stagflation. He even says that jobs cooling and inflation elevated and inflation is elevated, although he won't say, because they have no tools for it, that he is making the case for stagflation becoming a problem. Investors that ignore it are putting themselves at risk. If you ignore stagflation, you're putting yourself at risk. And I don't think that's a wise decision. He mentioned that the QE quantitative tightening ends in November or in December, and that the roll off of their balance sheet will go into the short end of the yield curve of the debt yield curve, T-bills. And he failed to tell you that that is quantitative easing light, a light version of quantitative easing. They say that QT is ending in December. What they don't say is that the next thing to come is quantitative easing, which is another reason that investors should be looking at um, gold, silver, and the precious metal stocks. When on the Wall Street stock issue, um, he says that there's no irrational exuberance. That it's even though the Wall Street stocks, especially the Mag 7 and the AI stocks, have very high valuations. He dismisses them as not worrisome. He says that it's not like dot-com era. Even though there is circular accounting, valuations are stretched and very troublesome. And I really believe we've got a bubbly scenario that is much like the dot-com era, which is another reason to look at the gold, the silver, the precious metal stocks, copper, and other metals, because when the dot-com era ended in the dot-com bust was exactly when gold, silver, copper, it started the 2001 to 2011 metals bull market that was initially led by gold, and gold, silver did very well. So another reason for investors to look at that. He talked about business spending is up, as are layoffs, and jobs are slowing. The jobs market is slowing. Says key factors are labor. The reason that Powell gives for the jobs market under trouble and that the layoffs are slowing is he talks about the labor participation rate and immigration. And that is the reason that and he talks about the labor force shrinking, and that also affects the economy because it's a demand issue. And if the supply is shrinking and the demand is going to as well, the economy is going to slow because there's less people in the jobs market. So where are those consumers? Where's that demand? They're limited to how much they can affect these things with interest rates. And AI is affecting spending and layoffs. So if there are more layoffs because of AI. There's less people that have jobs, and therefore they're going to spend less, which becomes a economic problem, which is part of the reason that I see quantitative easing coming up. These are my own notes. Corporate leaders and consumers are expressing poor sentiment. He touched on that in the question and answer period. He also talked about their tools are unable to satisfy both mandates. They have to throw one under the bus. They either have to throw the jobs in the economy under the bus or inflation, and that causes trouble on the on if when they throw the inflation on, if they throw one or the other, it causes problems on the other side of the dual mandate. If you cut interest rates, you increase inflation. If you lower interest rates, you or if you raise interest rates, you cause problems on the job side and the economy. There is an increasing stagflation problem. He makes all the case for it without saying it when he's talking. The QT ending and them supporting the short end of the yield of the debt market suggests that QE is incoming. That was one of the only comments I made today on my Twitter or X formerly Twitter, was that I said QE is incoming. I made that note while the question and answer period was happening, which will also make stagflation much worse. Okay, so I'm always about how investors can deal with these kind of situations, and I would reiterate something that I've said on past shows. During a stagflationary problem, precious gold, silver, and precious metal stocks do very well. So let's take a look at some of the charts so I can comment on that. Right off the bat, once the announcement was made and the press conference started, gold got beaten down, but it is then had an upswing and has come back down in after hours trading, although it's higher than this low. I want to go back to the daily chart for gold. It had a tremendous run since the Federal Reserve had their Jackson Hole, Wyoming meeting. It had a beautiful run. It's been suffering from some profit taking, but based on the stagflation problem that's arising, I think this is nothing more than a buying opportunity for gold investors. I think we're seeing the same thing in silver. Uh, as you can see at the Fed, when the Fed had their meeting or their Jackson Hole, Wyoming conference, it blasted off. It's also had some profit taking. And again, I think this is nothing more than a buying opportunity. After a big run, you're naturally going to see some profit taking, which we've seen, and it's been up since then. I'm going to go to the US dollar next. Or sorry, that's the S&P 500. So it dropped initially, had a rally, then another drop, another rally. I think this choppy action is for the concern that Fed Chairman Powell made about when he made comments about the December meeting is not a foregone conclusion. I 100% believe it is a foregone conclusion, but I think why he made those comments is because he wants to send a message to the politicians to end the shutdown. The data is going the wrong way for them. The jobs market, the economy, it's not going to be affected by these 2 quarter point moves. And so the idea that it's off the table or it's not a foregone conclusion, I think is absolute hogwash, but reading between the lines, I believe it is a message to the politicians to end the government shutdown because they need their data. They need their government made up data that understates the inflation and overstates the jobs and the economy. So they need something to hide behind. So I think that was more of the point. Um, uh, Powell did say that he did comment that the jobs market is the best indicator of the economy. I 100% agree with that, and it isn't trending in a good way. That's why this nonsense about December not being a foregone conclusion, it's an absolute 100%. They're going to cut in December. If they don't cut in December, then the next one will likely be a 0.5%. Um, Powell did say that the jobs market is slowing, supply is down due to the labor force participation and immigration, and they're trying to support demand. But these little quarter point moves aren't going to do anything, and that's why it is a foregone conclusion. We'll see. Maybe they won't, but then they'll have to do a 0.5 point after that. So we'll see how they decide. And the bottom line is Powell only has 4 more meetings, and then there will be a new Fed chairman. Even though I don't think it will be Mirren, it will be somebody who will be more forceful and probably have a better chance of getting the Fed to do what Trump really wants, which is to cut interest rates down back towards the free money era. And speaking of money, or the paper that is called money, upon the Fed, this is the daily chart, so you can see the action right after the Fed meeting. The U.S. dollar blasted off, and then it's come down ever since then in after hours trading. Um, and again, this action is because of the comments about the December meeting not being a foregone conclusion. If that's off the table, then that will be bullish for the U.S. dollar. But I think that it's not. In fact, I think a lot more are coming. So this short-term rallying in the U.S. dollar, I think, is overdone. And let's take a look at the daily so we can look at it's been in a correction. It's that started in January, brought it all the way down to the July lows. Since then, it's been trending sideways, but I think that this is just a short-term sideways action before it goes down further when the Federal Reserve starts cutting interest rates more aggressively. When the new guy comes in, or this next 4 meetings, we'll see. But I think ultimately the US dollar has more downside risk than upside potential. And that, again, is bullish for gold, silver, copper, all commodities that are priced in the US dollar. If the US dollar is going up, they're going, or down, they're going up. Okay, so the next chart I want to look at is the debt, the 10-year. As you can see, it dropped precipitously right after, well, it was dropping even before, and then it dropped even more significantly. And this means that the yields are going up. So the bond market doesn't is kind of having consternations as well because of the comments that came out of the Federal Reserve. Okay, so that's it for the Federal Reserve and their efforts to make stagflation worse. And let's talk about some companies that had news out today. I'm going to talk about companies that have gold companies that had earnings out today. So one of those is my top pick, which is in the major gold miners. I made them a pick in in early 2024. Since then, they've been making a series of record in free cash flow. In fact, the stock has went dramatically up since then. And even though it has gone up, I believe that they're cheaper today based on their free cash flow analysis than when I first picked them at $60 per share. That's in Canadian dollars, by the way. Okay, so here's the news. Agnico Eagle reports third quarter 2025 results. Record adjusted net income with another quarter of strong production. Financial position further strengthened by repayment of long-term debt and cash accumulation. See, that's the what the gold stocks are doing when gold is trading at around $4,000 per ounce. They reported financial and operating results for the third quarter of 2025. Ammar Al-Joundi, who is the president and CEO, stated, and I quote, "We delivered another quarter of strong and consistent operational performance, which translated into record financial results as higher gold prices continue to drive expanded margins. With solid year-to-date performance, we are well on track to meet our full-year production and cost guidance, supported by disciplined cost management and a focus on productivity. These are key, sorry, end quote. These are key reasons why I like Agnico Eagle so much. They are very good at keeping controls on their cost and increasing their productivity, which means for higher free cash flow. He goes on to state, Almar Al-Junde goes on to state, with the record free cash flow generation year to date and a strengthened financial position, we continue to advance our 5 key pipeline projects and create value through the drill bit. We remain disciplined in our approach to capital allocation, and we continue to provide strong returns to our shareholders through dividends and share buybacks. So here's some of the highlights. Strong quarterly gold production. Higher gold prices generated stronger margin while impacting royalty costs. Record quarterly adjusted net income and strong free cash flow generation. 2025 gold production and unit cost guidance reiterated. Financial position further strengthened through our cash accumulation and debt repayment. So they're building up the cash, paying down the debt. Great. That's a great business no matter what sector you're in. Increased quarterly share repurchases demonstrated continued focus on shareholder returns. So they're doing something with their cash that says to investors that they think that their stock is undervalued, and that's why they're buying the stock with their cash. They talk about key value drivers. You can read all that in the news release. So that is one of the reasons why they have been performing back here. When I first picked them, they were trading at about $60 a share Canadian. They closed today at $218. I think this recent movement back to the 50-day moving average is something like what we saw here. Good time to buy because look at the run. It ran from 165-ish all the way up to 265. So in a very short period of time, it gained $100 per share. And this recent weakness related to what's happening with gold, I think, is a great opportunity for investors that like to invest in free cash flow machines. Okay, so the next company up is Alamos, another of my top picks that I picked in the first early part of 2024. They were my top mid-tier pick. They still are my top mid-tier pick. mid-tier gold producer, and they reported their third quarter results. Growing production and margins drive record quarterly free cash flow of 130 million. They reported for the quarter ending September 30th, 2025. Their chief executive officer, John McCluskey, stated, and I quote, "We delivered a number of new financial records in the third quarter, including record free cash flow of 130 million, while continuing to fund our high return growth projects. This was driven by further increase in production to 141,700 ounces and significant margin expansion. Given unplanned downtime of the Magino mill at the end of September and lower expected underground grades from Allan Gold due to a seismic event in October, we are revising our 2025 production guidance lower by approximately 6%. These challenges are short-term and are not reflective of our strong outlook nor our long-term track record. We expect a significant improvement starting in the fourth quarter with an 18% increase in production and a 5% decrease in cost," McCluskey added, end quote. And so, even though they have some, this is part of the mining business, folks, and it's only affecting 6%, but they are increasing their fourth quarter production by 18% and 5% decrease in costs. And that's coming into the best quarter ever for the price of gold. It's currently at around $4,000 an ounce, and it has been in record territory for almost the entire quarter. So I believe this record in free cash flow is only going to go up. And here's another key point. While they have records in free cash flow, they're funding their high return growth projects. When they talk about high return, what they mean is that they're taking their free cash flow and they're spending it to increase their production and decrease their costs. They're spending their free cash flow to increase their free cash flow. Even if gold were to go sideways or down, they're still going to be in a better financial position due to these actions. And so that is the story from Alamos. I'll just pull up their stock chart. Again, this one I picked early in 2024 when they were trading at about $16 a share. They're currently trading at $44.44. Oh, that's a good number for those numerology people out there. But the numbers that I care about are those free cash flow and how they're spending their free cash flow to increase their free cash flow. And then you've got gold in the best quarter ever. This is all very good for the free cash flow at Alamos. Okay. And the final company today, it's certainly smaller than the others, but punches above its weight. Aris Mining. Aris Mining reports Q3 2025 results. Segovia ramp up driving profitable growth, record revenue, cash flow, and adjusted earnings. This is for the September quarter ending and September 30th, and the 9 months ended at the same date. Okay, Q3 revenue at 253 million, up 27% from Q2 2025. So quarter over quarter, up 27%, and 93% from Q3 2024. So year over year, quarter over quarter, the revenue is going up, driven by higher gold prices and increased sales volumes. Adjusted earnings before interest, tax, depreciation, and amortization. Adjusted net earnings are up to 36 cents per share. Cash balance increased to 417.9 million as of September the 30th, up from 310 million at the end of June. So after the second quarter, they increased their cash by 107.7 million, folks. That's what happens when you're a good gold miner. 90.8 million of the cash flow after sustaining capital income taxes, 60.5 million of proceeds from the exercise of the Aris warrants. So they had some tradable warrants that expired, and that brought them in 60.5 million. 13.2 million of the proceeds from the sale of their Juby Gold project. So that was a non-core asset. Uh, Net debt reduced to 64 million, down from 241 million at the end of 2024. So not only are they building up their cash, they're paying down their debt, and now it's a minimal 64 million. And when I say minimal, that's compared to their cash position, which is 417 million. Okay. Neil Woodyer, who is the CEO, he commented, and I quote, the production ramp up at Segovia is progressing well, leading to record financial results and a cash balance of 418 million. This year, we have also delivered two major technical studies, the Soto Norte pre-feasibility study and the Toro Paru preliminary economic assessment. These projects reinforce the strength of our growth pipeline beyond Segovia and Marmato, where construction of the bulk mining zone remains on schedule for first gold in the second half of 2026. With record revenue, cash flow, and earnings in Q3, Aris Mining is financially strong and strategically positioned for continued growth into 2026 and beyond. So Segovia is their mine that's generating all this free cash flow. It's just a very impressive, low cost, high margin mine. The next one is Marmato, where they are in construction of a bulk mining zone that is on schedule, as he states in his comment. And yeah, there they talk about the gold production, the Marmato narrow vein produce what it produced, Segovia operations produced what it produced. The all-in sustaining cost margin increased to 121.5 million, up 39% from Q2 2025. That's what happens, folks, when you've got gold doing what it's doing. And this is the best quarter ever. The fourth quarter of 2025 is even better than the third quarter. And so that's quarter over quarter growth, folks. Our improvement on a trailing 12-month basis, the all-in sustaining cost margin has reached 327.9 million. Owner operated mining all-in sustaining cost was $1,452 per ounce. Folks, we're currently trading at around $4,000 per ounce. That's a huge margin compared to 1520 in Q2 2025. So even quarter over quarter, they were able to bring their costs down by $130, or sorry, about what is that? $70 per ounce, bringing the 9-month 2025 average to $1,482 per ounce, tracking toward the lower end of their full year 2025 guidance range of $1,450 to $1,600 an ounce. Contract mining partner Sourced Gold delivered an all-in sustaining cost sales margin of 44%. So no matter how you cut it, no matter how you look at it, Aris Mining is firing on all cylinders when it comes to their operations, low cost, high margins. Let's take a look at their stock, Aris, Aris Mining. Hold on. Why is it giving me a problem here? Oh, there it is. So this is trading on the Toronto Stock Exchange. I believe I picked it right around here when they had this last dip and then it rallied quite significantly. But I didn't pick it because of this rally. I picked it because of all of those great metrics that they talked about in their quarterly report. Now, while gold has been taking some profit taking, the gold stocks have as well. But I think that this touch of the 50-day is very similar to this touch of the 50-day. And I think this is a great one for you to do your homework on. Okay, so that is my show for today. As always, I'm only an idea generator. I don't make buying or selling recommendations. You have to speak with your financial advisors and talk about your risk profile before making any investment decisions. It's also really important for you to do your homework. I am a big proponent. On every show I do, I tell investors to do their homework. And I don't, that's not just a mining company related thing or gold or silver. I think that investors that do their homework are the best investors. They make investment decisions based on data and logic and facts and not short-term fluctuations in the price of, in this case, gold or their stock price. They can make it based on the reality of what you see, in this case, in their quarterly reports. Do that homework. Read those quarterly reports. I'm only an idea generator. You got to do your homework. And on that note, you have a great day and we will talk to you soon.